The math simply does not add up. We are currently witnessing one of the greatest anomalies in financial history, a moment where the indicators of economic health and the actual price of assets have completely decoupled. By every traditional metric used over the last century, the warning lights aren't just flashing, they are burning out from overuse. And yet, the market climbs. It defies gravity. It ignores bad news. It mocks the fundamental laws of supply and demand. But this isn't resilience. This is something far more complex and, frankly, far more artificial. To understand why the crash hasn't happened, we have to stop looking at the stock market as a reflection of the economy. That creates a false narrative. Instead, we must view the current financial system as a pressure vessel. The indices, the Dow, the S&P, the Nasdaq, are no longer gauges of corporate health. They have become gauges of liquidity injection. We are seeing a psychological phenomenon known in behavioral economics as the normalized deviation of risk. When a system is artificially supported for too long, market participants stop fearing the drop and start betting on the net. But here is the critical question the data begs us to ask. If the fundamentals are fracturing, where is the money coming from to keep the prices so high? History offers a chilling parallel. In the months leading up to major corrections, there is often a period of irrational calm. But today, we have a new mechanism at play that didn't exist in 1929 or 2000. It's called the volatility suppression loop. Large institutional algorithms are now programmed to sell volatility the moment it spikes, effectively crushing any downward momentum before it can turn into a panic. They are not investing in value, they are harvesting premiums. This creates a feedback loop where the market seems invincible, not because it is strong, but because the mechanism to allow it to fall has been temporarily disabled by massive algorithmic leverage. Why does this matter to you? Because this invincibility creates a distorted reality for your personal economy. You see the numbers on your screen, your retirement account, your home value estimate, and they suggest wealth. But then you go to the grocery store, or you try to buy insurance, or you look at the interest rate on a car loan, and you feel a distinct tightening. This is the cognitive dissonance of the modern era. The system is designed to keep asset prices high to maintain the illusion of solvency for the banks, while the real cost of living erodes the actual value of the currency in your pocket. You are living in two economies simultaneously, the paper economy of high stocks and the physical economy of shrinking purchasing power. The market hasn't crashed because it has been engineered not to. The floor has been raised by trillions of dollars in silent capital. But engineering has limits. Physics eventually demands payment. And while everyone is looking at the stock charts waiting for a red candle, the real fracture is forming in a completely different sector, one that the banks are desperate to keep out of the headlines. The stability you see is not natural stability, it is purchased stability. The reason we haven't seen a chaotic unraveling is not because the structural beams of the economy are strong, but because the plumbing has been flooded with an unprecedented amount of liquidity. We are not operating in a free market anymore. We are operating in a managed ecosystem where the price of money is the only variable that matters. And right now, that variable is being manipulated behind a curtain of complex financial instruments. Let's talk about what the banks are actually hiding. It's not necessarily fraud in the traditional sense, it's exposure. Specifically, exposure to shadow banking and private credit. Since the regulatory tightening after 2008, traditional banks stopped doing the risky lending. But the demand for risky loans didn't disappear. It moved into the shadows: private equity firms, asset managers, and non-bank lenders. This sector has ballooned to trillions of dollars, largely unregulated and opaque. The stock market stays up because these private entities are absorbing the bad debt, hiding the losses in illiquid funds that don't mark their assets to market value every day. They pretend the asset is worth 100 cents on the dollar, even if the market would only pay 60. Here is the mechanism that keeps the illusion alive. Extend and pretend. This is a documented banking strategy. When a commercial borrower, say a massive office tower owner, cannot pay their loan, the bank doesn't foreclose. Foreclosing forces the bank to realize a loss, which hurts their stock price and alarms shareholders. Instead, they issue a new loan to pay off the old one, often capitalizing the interest. They kick the can down the road. They are zombie walking billions of dollars of bad commercial real estate debt. As long as they don't sell, they don't have to admit the crash has already happened in the real estate sector. The stock market is pricing in a perfection that simply doesn't exist on the balance sheets. This institutional sleight of hand has a direct impact on the stability of your local community. When capital is trapped in zombie companies, firms that barely make enough money to pay the interest on their debt, it cannot be used for innovation, hiring, or wage growth. This is why we see jobless growth or stagnation in real wages. The capital isn't flowing to productive businesses. It's flowing to service the debt of failing ones to prevent a systemic collapse. You feel this as a lack of dynamism in the job market or a hesitation in small business lending. The banks are hoarding safety, leaving the risk to the public. So the banks are hiding the losses in private credit funds and commercial real estate portfolios, hoping that interest rates drop before the bills come due. They are betting on a pivot. They are betting on a rescue. But there is a flaw in this strategy. There is a specific threshold where extend and pretend stops working mathematically. And when we hit that number, the reaction won't be slow. It will be instant. But here is the part nobody expected. The trigger might not come from the banks at all. While Western markets celebrate resilience, the rest of the world is quietly preparing for a funeral. If you broaden your scope beyond the New York Stock Exchange, you see a very different narrative unfolding. Global central banks are buying gold at the fastest pace in over 50 years. This is not a standard diversification strategy. This is a defensive fortification. They are de-risking from the very system that is currently propelling US stocks to all-time highs. They see what the algorithm-driven domestic traders are ignoring. We need to discuss the carry trade and global liquidity flows. For years, investors borrowed money and currencies with low interest rates, like the Japanese yen, and invested it in high-yield assets like US tech stocks. This global arbitrage acted as a constant upward pressure on the market. It was essentially free money pushing stocks up. But as global interest rate policies diverge, that flow is becoming erratic. We saw a glimpse of this volatility recently, a tremor that shook the foundation. The stability of the US stock market is heavily dependent on foreign liquidity remaining passive. If that capital decides to go home, the vacuum it leaves behind cannot be filled by retail investors. There is a historical parallel here to the period just before the dot-com burst, but with a geopolitical twist. We are seeing a bifurcation of trust. The Global South and BRICS nations are building alternative payment rails, effectively trying to insulate themselves from a potential dollar or market crisis. This matters because the US stock market's valuation is partially a monetary premium. People park money there because it is seen as the safest house in a bad neighborhood. If that perception shifts, if the safety is questioned because of debt levels or political gridlock, the premium evaporates. We aren't just looking at earnings multiples. We are looking at a confidence index that is fraying at the edges. Think of this like a neighborhood where one house is priced double what the others are, simply because everyone believes it's the only one that won't burn down. That belief is the value. If you strip away the geopolitical dominance, the valuations of many of these companies, trading at 30, 40, or 50 times their earnings, become mathematically impossible to justify. As a regular investor or a citizen, you are unknowingly betting on geopolitical stability every time you buy an index fund. You are betting that the US dollar remains the undisputed king. And while it is still strong, the walls of the castle are being tested daily. The world is watching the US debt clock and the stock market disconnect, and they are hedging their bets. They are moving into hard assets while Western investors chase digital paper. The tension is palpable. The elastic band is stretched to its absolute limit. But the snapback, when it comes, won't look like the crashes of the past. It gets deeper, because the crash might not manifest as numbers going down, but as the value of money changing entirely. The ultimate realization, the one that keeps the smartest macroeconomists up at night, is that the market might never crash in nominal terms. We are waiting for a deflationary bust, a moment where the Dow drops 50%. But what if the strategy is to prevent that at all costs, even if the cost is the currency itself? The crash you are preparing for is the wrong crash. The crash isn't in the stock price. The crash is in the purchasing power of the dollar that buys the stock. This is the Venezuelan paradox applied to a developed economy. In hyperinflationary or high inflationary environments, the stock market often goes up. It skyrockets. Why? Because the currency is losing value so fast that people rush to buy any asset, stocks, real estate, commodities, just to get out of cash. This is the scenario the media rarely discusses. If the central banking system is forced to print trillions to cover the bank losses we discussed in Section 2, the stock market will rise. It will hit new highs. You will feel rich looking at your portfolio, but those gains will be a mirage, eaten alive by the rising cost of bread, energy, and shelter. We are already seeing this. This is the K-shaped reality. Asset holders, those who own stocks and homes, are seeing their nominal wealth explode. Wage earners, those who rely on a paycheck, are seeing their reality collapse. The banks are hiding the structural rot by inflating the balloon. They know that a deflationary crash, prices going down, destroys the banking system. So they will choose the alternative, inflationary stagnation. They will sacrifice the value of the currency to save the solvency of the institutions. This is a transfer of wealth from the savers to the debtors, from the working class to the asset class. This is the most critical shift for your family's future. The crash has been redefined. It is a slow-motion erosion of your standard of living, masked by a booming stock market. If you are sitting in cash, waiting for the bottom to drop out so you can buy in, you might be waiting forever, while the real value of that cash dissolves. The system is designed to force you into the casino. It forces you to take risks just to maintain your baseline. It is a coercive economic environment where saving is punished and speculating is mandatory. The stock market hasn't crashed because it has become the primary vessel for absorbing excess currency. It is a dam holding back a flood of liquidity. But dams don't need to break to fail. They just need to overflow. Because while the world is hyper-focused on the daily fluctuations of the S&P 500, staring at the red and green numbers, the real transformation is already unfolding, quietly, and in the one place almost no one is looking.